If you own gold and silver, this Fed signal changes everything. What if the biggest warning sign in today's economy isn't a headline at all, but a sentence the Federal Reserve just quietly removed from its own policy statement? Most people won't notice it. Most investors are too busy watching the price on their screen to notice the words behind it. But central banks don't choose their language by accident. Every phrase is measured. Every omission means something. And this year, the Fed removed something it had used for years. By the end of this video, you'll understand exactly what that missing sentence means, why gold and silver investors specifically should be paying attention to it, and what history says happens next when a central bank makes this exact move. This isn't speculation. This is a pattern that has repeated for decades, and once you see it, you won't be able to unsee it. Here's what you'll walk away with today. You'll understand what forward guidance actually is, and why a central bank giving it up is far more significant than most financial commentary gives it credit for. You'll see how this moment compares to previous turning points in Fed history, moments that, in hindsight, marked the beginning of major moves in gold and silver. And you'll learn the specific signals that smart money is watching right now, so that if this pattern continues, you're not finding out from a headline, you're finding out before one. Let's start with what actually happened. In June of this year, the Federal Reserve held its benchmark interest rate steady, in a range between 3.5% and 3.75%. On the surface, that sounds uneventful, rates unchanged, nothing to see. But this meeting was different for three reasons. First, it was the first meeting under a new Fed chair, Kevin Warsh, who was confirmed by the Senate in May of this year. New leadership at the central bank is always a moment markets watch closely, because a new chair often means a new philosophy. Second, the meeting saw the removal of key language that had signaled a bias toward future rate cuts, inside a dramatically shorter policy statement. The Fed didn't just hold rates, it quietly stopped promising where rates were going next. Third, and this is the part almost nobody talks about outside of trading desks, the Fed's own projections showed that 9 of 18 voting members expect a rate hike before the end of this year, with 6 of them expecting 2 separate hikes. Not cuts, hikes. That is a complete reversal of what markets were pricing in only months earlier. So why is this happening? Why would a central bank move from cutting rates to considering hikes? The official reason is inflation. Inflation has been running well above the Fed's long-stated 2% goal, and by the Fed's own admission, that's been the case for more than 5 years. The Fed's updated projections show inflation running at 3.6% this year, still far from where the central bank wants it. Part of this is being driven by the conflict in the Middle East, which has kept oil prices elevated even after a provisional peace deal was reached. Energy costs ripple through everything: transportation, manufacturing, food. When oil stays expensive, inflation stays sticky. But here's the phrase that should really catch your attention. The new Fed chair said something in public that central bankers almost never say. He said, quote, "Inflation is a choice." Think about what that actually implies. It's not blaming supply chains. It's not blaming a war overseas. It's placing the responsibility for inflation squarely on monetary policy decisions, meaning on the Fed itself, and by extension, on how much money has been created and how loose policy has been for how long. That's not a small philosophical statement. That's a signal about how this Fed intends to fight inflation going forward, and it suggests they may be willing to keep rates higher for longer than markets expected. That's only part of the story, because to understand why this matters for gold and silver specifically, we need to look backward. History has been here before. Gold and silver don't respond to headlines. They respond to one thing above all else: the real cost of holding cash versus holding a hard asset. When a central bank fights inflation with high interest rates, but inflation stays stubborn anyway, something called the real interest rate, the interest rate minus inflation, can stay low or even negative. And that environment, historically, has been fertile ground for gold. Think back to the late 1970s. The Fed was raising rates aggressively to fight inflation that had spiraled out of control. On the surface, higher rates should have hurt gold because gold pays no interest. But because inflation was rising just as fast, or faster, than rates, the real return on holding dollars was still negative. Investors who understood that mechanism moved into gold, and gold went on one of its largest historical runs. The lesson isn't high rates are good for gold or high rates are bad for gold. The lesson is more precise than that. What matters is the gap between the rate and the inflation rate underneath it. When that gap stays negative, hard assets tend to win. When central banks manage to close that gap convincingly, hard assets often cool off. Right now, we have a Fed holding rates at their highest level in years, openly discussing hikes rather than cuts, but doing so against inflation that its own projections admit isn't coming down as fast as hoped. That combination is exactly the kind of environment gold and silver investors have historically needed to watch closely. But rates and inflation are only half the picture. There's a second signal buried in this Fed meeting that most coverage completely missed. For years, the Federal Reserve has practiced something called forward guidance. In plain terms, it's the Fed telling markets in advance roughly what it plans to do: cut rates, hold rates, raise rates, so that markets aren't caught off guard. Forward guidance is a tool of confidence. A central bank uses it when it feels it understands where the economy is heading clearly enough to commit to a path. This Fed just dispensed with that. The new chair said the committee is moving away from traditional forward guidance altogether, focusing instead purely on incoming data. Fox Business. Why does that matter? Because a central bank that refuses to commit to a path is, in effect, telling you it doesn't have enough confidence in its own forecast to make a promise. That's not a confident institution. That's an institution bracing for surprises. Surprises that could come from either direction: inflation or growth. For gold and silver investors, uncertainty at the central bank level is not a neutral event. Precious metals have historically thrived in exactly this kind of fog. Periods where the market can't get a clear read on what comes next, and where investors start hedging against multiple possible outcomes at once, instead of just one. Most investors focus on the headline number. Did rates go up? Did rates go down? But that's not the real story. Smart money watches the language, the composition of the vote, and what isn't being said. Here's what smart money watches: the gap between what a central bank promises and what it delivers. When that gap widens, when a Fed abandons its own guidance, it tells professional allocators that policy could swing harder in either direction than the market currently expects. History quietly tells a different story than most headlines suggest. Every major precious metals cycle of the last 50 years has coincided with a moment where confidence in central bank forecasting broke down. Not necessarily a moment of crisis, but a moment of admitted uncertainty. That's the environment we may be entering again. Now, nobody can tell you with certainty what happens next. Anyone who guarantees an outcome in markets is selling you something. But we can lay out the conditional paths based on what the data and the Fed's own projections currently suggest. One scenario: the Fed's own summary of projections shows inflation cooling to 2.3% by 2027 and further to 2% by 2028. If that plays out and hikes prove unnecessary, the Fed may eventually pivot back toward cuts. And historically, the anticipation of rate cuts, combined with residual inflation damage already done to the currency, has been a powerful tailwind for gold and silver. Another scenario: if inflation proves more stubborn than the Fed currently projects, and the committee does move forward with the hikes some members are signaling, higher rates could initially pressure precious metals in the short term, as holding cash becomes more attractive on paper. But if inflation stays elevated even as rates rise, the real rate, remember, that gap we talked about, could remain compressed, continuing to support gold's core investment case even through a hiking cycle. A third scenario: continued geopolitical instability, particularly around energy markets tied to the Middle East, keeps a floor under inflation regardless of what the Fed does with rates, sustaining demand for gold and silver as a hedge against factors monetary policy alone can't control. If this trend continues, gold and silver investors are watching a genuinely two-sided setup, not a simple rates up, gold down story, but a more layered one, where the relationship between inflation and rates matters more than either number alone. If you're finding this analysis valuable, subscribe to John A.G. Wealth. Every week, we break down the economic signals shaping global markets before they become tomorrow's headlines. And if this video is helping you understand the bigger picture, hitting the like button helps more people discover thoughtful financial analysis instead of speculation. So what should you actually be watching going forward if you want to stay ahead of this instead of reacting to it? First, the next FOMC meeting, scheduled for late July. Watch not just whether rates change, but whether the language softens or hardens further around future hikes. Second, watch the inflation data releases between now and then. The Fed has explicitly said it's now driven by incoming data rather than a fixed forecast, which means every inflation print between meetings carries more weight than it used to. Third, watch real yields, the difference between Treasury bond yields and inflation expectations. This is the single most consistent signal gold has responded to across market cycles. When real yields fall or turn negative, gold tends to strengthen. When real yields rise convincingly, gold tends to face headwinds. Fourth, keep an eye on the dollar. A Fed that stays higher for longer tends to support the dollar in the short term, which can create temporary pressure on dollar-denominated metals. But this pressure has historically been temporary if inflation itself doesn't retreat alongside it. And fifth, silver specifically. Silver moves with gold as a monetary metal, but it also responds to industrial demand, particularly from electronics, solar, and manufacturing. Watch industrial demand data alongside the monetary signals, because silver can diverge from gold when industrial cycles shift. Do you think this shift away from forward guidance is being underpriced by the broader market right now? Would you be buying into weakness here, waiting for more confirmation, or staying on the sidelines until the July meeting? Let me know where you stand in the comments. I read every one. Big takeaway. Here's the core idea to take with you. The headline number, whether rates are cut or hiked, has never been the real story for gold and silver. The real story has always been the relationship between rates, inflation, and confidence in the institution setting policy. Right now, we have a new Fed chair, a central bank openly discussing hikes instead of cuts, an explicit abandonment of forward guidance, and inflation that the Fed's own data admits isn't cooling as fast as hoped. That combination doesn't guarantee any single outcome, but it is, historically, exactly the kind of environment precious metals investors have needed to watch closely, because it's the environment where the gap between policy and reality tends to widen before it narrows. Markets rarely reward those who react to headlines. They tend to reward those who recognize the signals before they become obvious. The real question isn't whether change is coming, it's whether you'll recognize it in time. If you found this analysis valuable, subscribe to John A.G. Wealth for more in-depth market breakdowns. Like this video if it helped you see the market differently, and share your thoughts in the comments. And if you want to stay one step ahead, watch the next video on this channel, because the next signal may already be forming.